Well, markets got off to a pretty lousy start in August, stocks ending the week lower following that US credit downgrade from Fitch. Well, now things are looking up, with stocks climbing higher in hopes for some positive news this week. But can we expect the good times to keep rolling? Joining us now is Veronica Willis, Wells Fargo Investment Institute Global Investment Strategist. Good to have you on the show here. So, Veronica, obviously coming off a losing week here, what are the expectations now coming into this week?
I think it's just like you said, this week is going to be very data driven. We've got that consumer price inflation later this week, producer price inflation, and the market is going to be watching those very closely, especially those core inflation numbers, because they know that the Fed is watching that core inflation very closely. They're watching services inflation very closely for signs of easing. Core and services inflation have both been very slow to ease, and if you see those numbers pop back up or even slow less than expected, the market may take that as a sign that the Fed is going to stay a little bit more aggressive than they're currently expecting.
And so then in terms of the risk that you think the market is currently pricing in, are they undershooting it at the moment, or will this really be a big swing when we get that CPI data?
I think they may be undershooting it a little bit, or maybe underestimating how far the Fed is willing to go. Even if inflation comes in with where the market is kind of expecting it, I think that's still not good enough for the Fed. They've remained committed throughout this entire tightening cycle. They want to see inflation down to 2%. They've talked about over and over again the different measures of inflation that they're watching, that they need to see that core number come down. They need to see that kind of super core number that they say that they're watching come down more meaningfully. And so this, last month of CPI that we saw, that year over year number come down to 3%, was a, great improvement in CPI to get that down to a 3 handle, but it's still not the 2% number that the Fed wants to see.
And so with that in mind, and still having this higher for longer narrative going, then what should people be looking at in terms of what to rotate in and out of as you try and sort of see where the Fed goes from here, and obviously still very data dependent?
Yeah, I think it's key to kind of be a little bit more defensive right now. Within equities, we like the large cap equity space more than mid and small cap, because we think that the large caps can be a little bit more resilient through the volatility and through all of the economic and market uncertainties. And then in the fixed income space, take advantage of those higher yields on the short and the long ends of the curve.
And when you're looking at quality, what are some of the standouts? So what are some of the markers that are letting you know this is the sort of space to get into versus sort of pausing or perhaps keeping some cash on the sidelines?
Yeah, so thinking of those quality areas within equity, we're looking for those sectors where the companies have, bigger balance sheets, they've got better debt to equity ratios, companies that are just in better financial conditions to weather an economic downturn or to weather a recession.
And I do want to ask you about this. What can be considered the new normal? I mean, we had historically low interest rates for years. So we got comfortable, we got used to the Fed being in a certain space. What do you think the new normal is going to look like as we head into this sort of uncertain sort of pause slash pivot phase, and what that expectation actually does for valuations as well?
I think that the new normal, it's not going to be interest rates at the levels they are now, but it's not going to be the zero interest rate level that we had, in the previous decade. So we're going to be kind of somewhere in between for that new normal. And I think we're going to have to see kind of a reset in expectations for where valuations are, and just have the market kind of reset itself just a little bit for expectations. But I think it will be beneficial to see the interest rates eventually come down from current levels.
And obviously, we know that the Fed is looking at a lot of backward-looking data that has a lag. In terms of forward-looking indicators, what do you think is giving you really a closer, a more accurate view of where the economy is headed from here, as we sort of gauge this idea of how soft of a soft landing the Fed might be able to land here?
I think one of the really great indicators are looking at those kind of weekly jobless claims numbers and those more kind of week to week updates that we'll get on the labor market, because that resilience that we've seen in the labor market is really what's driving the consumer. And what's driving the consumer is really what's keeping the economy afloat. And so once you really start to see initial jobless claims consistently coming in higher than what consensus is expecting and starting to trend higher again, then that's a sign that maybe the labor market is starting to cool a little bit more meaningfully.
Indeed. Fed not seeming to be convinced quite just yet on that labor market, so definitely one to watch. A big thank you there to Veronica Willis, Wells Fargo Investment Institute Global Investment Strategist. Thank you for your time this morning.